So in this video we're going to cover the profit and loss. We're going to understand why we need it, what it's used for, what it looks like, and we're also going to do some examples as well. Got to make sure the background's nice, otherwise my girlfriend gets upset when she watches the video. So first of all, we want to understand why it's needed. So alongside the balance sheet is another report that we use to understand how the business is performing. It doesn't necessarily give us a full picture of how healthy the business is in terms of its assets and its liabilities, but it gives us an understanding of how profitable the business has been during the year. It's also really good to understand how much the business is spending in key areas, and also helps highlight areas where you can attempt to reduce costs in order to improve profits and profitability. Additionally, as well as helping for investment and bank loans with the balance sheet, it's really key for management reporting, as we've already highlighted, because it's a good way to indicate how the money is being spent within the business. And although it's not required for all account submissions, the majority of accounts that are submitted to Companies House at a business's year end, they need a profit and loss to be included. It's not the profit and loss that I'm going to show you, as I'm going to show you a very detailed one with the key expenses. However, the usual profit and loss that's submitted to Companies House is simply revenue, one line that says cost of sales, one line that says operating expenses, and one line that's for the profit. In bigger accounts, you are required to submit a detailed profit and loss, but I'm not going to go into these different rulings for the accounts and their reporting requirements. So what does it look like? In my financial statements video, I included a screenshot of what a profit and loss typically looks like, and I'm going to include it again here. So as you can see, we've got a line for ordinary income, a line for other income, as well as lines for cost of sales and other operating expenses such as rent and salaries. This is quite a simple profit and loss report, and typically with quite a lot of the clients I deal with, they can have pages and pages of profit and loss, although that's not ideal for analysis because you want a clean and concise profit and loss that you can easily see key areas, although some managers prefer to have a more detailed breakdown. It really just depends on the manager who's reviewing the work. So let's drill down into what each of the headings mean. So ordinary income, which can also be referred to as ordinary revenue, is the money that is generated by the business in its normal course of trading. So in this example, a t-shirt company, it would only record its t-shirt sales in here. Bank interest and rental income, if you rent out a spare warehouse that you aren't using at the moment, they would go under other income because it's not within the trading activities of the business. Cost of sales is essentially the costs incurred to generate your revenue. So it's typically materials if you're a t-shirt company, but if you're, say, an advertising company, it could be payments for campaigns in newspapers. If you're a accountancy firm, you could typically class your cost of sales as your staff salaries because you have to pay their salaries in order for them to generate you income. So it varies depending on the industry you're in. Operating expenses is things such as overheads like rent, salaries if you're not a services based business, utilities, teas, coffees, anything of that nature that isn't related to your generating a revenue but is needed in order to keep the business running. So now that you can kind of see the general breakdown of the profit and loss, and it's quite simple and straightforward to how you'd create one yourself, I'm going to show you with the profit and loss that we've just looked at a few examples and how it would affect the profit and loss. We're going to be talking about quite a lot of debits and credits, so if you're not sure, then make sure you check out my debits and credits video, which I'm going to link up in the right corner, and I'm also going to link it in the description below. So here are the examples that we're going to go through. So the first entry is we rent out a spare warehouse that we usually keep our t-shirts in. We rent it out for 2 months and we're charging it out at £2,000 per month. So as you can see, we've got a rental income ledger in our other income that we're going to put our rental income into. So we credit our other income, as income is a credit account, anything we credit in here is going to be positive. So we want to credit £2,000 for each month. So that's going to be £4,000 in total. Now, the debit side of this transaction, if they're paying in cash, would be cash, which is a balance sheet item. If they were paying on credit, it would still be an asset and it would go to accounts receivable, because that's where our unpaid invoices go that are going to be received. Either way, our debit affects our balance sheet and has no impact on our profit and loss, so we don't need to worry about this other entry. Adjustment 2 is we sell 500 t-shirts in cash for £200. When we sell t-shirts, we recognise it as a movement in income or revenue because we've made a sale, but we also need to recognise a movement in cost of sales because our inventory is also going down. Now, if you watched my balance sheet video, you'd know that we had a transaction where we bought t-shirts and we bought 100 for £200. Now we're selling 50 of them, so half of it. Our cost of sales is going to be £100 because half of our inventory cost £100. So in order to recognise the movement in the inventory, we need to recognise an expense of £100 here. But we've also made a sale of £200, so we need to increase our income of £200. So if we go over the two transactions we've just put in and talk about the debits and credits, we know that the sale was for £200, so we would debit our cash, which is a balance sheet item, so it won't affect the profit and loss, and we'd credit our income, which we've just added in our t-shirt sales line. The other side of this, the additional transaction we need to put in is the movement for the inventory of the sale. So we would credit inventory to reduce our inventory figure on the balance sheet, which is a balance sheet item, so it won't affect our profit and loss. And we need to debit our cost of sales, which is exactly what we've done in the t-shirt materials line. The third entry is we pay staff salaries for £200. So our double entry is going to be credit our cash for £200, which is balance sheet, so it doesn't affect the profit and loss. And then we debit our salary expense code. So that would just simply be adding £200 to this. Finally, we incur interest on our bank loan of £50. So I've added a loan interest in the other expenses section of the profit and loss. Now, in our balance sheet video, we took out a loan for £2,000 in order to fund buying more t-shirts. Now, the double entry for this is as follows. We know that the expense is going to be £50, so we debit our other expenses of £50. The other side of this is going to be a credit. The credit is going to go to our bank loan account because the interest needs to be paid by us, so it will increase the money we owe for the bank loan, and therefore we need to increase that liability, so we would credit the bank loan. So that is essentially how the profit and loss works, as well as the examples that show us typically the entries that would go through it. I hope that you found this useful, and if you enjoyed the video, please like it. I'd be honoured if you subscribed, and I'll see you in the next one.